Have you ever watched a stock price move, sometimes dramatically, and wondered why? Especially when there's no obvious news. And have you ever stopped to think who's really pulling the levers behind those price swings?
Look, these aren't just some abstract questions. The answers are absolutely fundamental to understanding how markets truly work. Welcome to our Finance Masterclass. In this first session, Topic 1.1, we're going to break down the very architecture of financial markets. We'll focus on who the players are and, critically, how information flows between them.
So, here's our game plan. We'll start with the market's core purpose. Then, we're going to meet the different players in this ecosystem. After that, we'll trace the flow of information. Think of it as the market's nervous system. We'll see how that information actually becomes a price change. And finally, we'll talk about what all this means for you.
Okay, let's dive right in. The best way to think about the market is not as a single thing, but as a complex ecosystem. It's filled with different players, and each one has their own goals, their own advantages, and their own limitations. Understanding who they are is the first crucial step.
At its core, this entire ecosystem is split into two big camps. On one side, you have what we call the buy side. These are the end users. We're talking about investors like you and me, mutual funds, pension funds, anyone looking to put capital to work. And on the other side, you have the sell side. These are the facilitators, the investment banks, the brokers. Their main job isn't to invest for the long term, but to make the market work for the buy side, and they earn a fee for doing it.
All right, let's start with us, the retail investor. Our objective is pretty straightforward. We want to preserve or grow our wealth. Our biggest advantage? It's agility. We can get in or out of a stock without causing a ripple in the price. And we don't have a rigid mandate, which means we can patiently wait in cash for the perfect setup. But our biggest weakness, our constraint, is information. We are almost always the last to know anything important.
Okay, now let's contrast that with the real giants of the market, institutional investors, like foreign and domestic institutional investors. Their goal is usually to outperform a benchmark like the Nifty 50. Their advantage is just raw information power. They have huge research teams, they have direct access to company management. But their massive size is also their biggest weakness. A fund that manages thousands of crores can't just click a buy button. Their orders are so huge they create what's called an impact cost, which means their own buying pressure actually pushes the price up against them.
Okay, so what about the other side of the coin, the sell side? A market maker's goal is to make a tiny profit on the difference between the buy price and the sell price. That's the bid-ask spread. They might buy from you at 100 and offer to sell to someone else at 100.05, and they do this millions of times a day. Their edge is speed and direct access to order flow data. Their biggest fear, though? Inventory risk. They absolutely hate holding a large position overnight, because if bad news hits, they could face massive losses. Their ultimate goal is to end every single day with a flat book, meaning they own nothing.
And of course, holding this entire structure together is the core infrastructure. You have the exchanges, like the NSE and BSE. They provide the venue and the technology, the matching engine, that connects all the buyers and sellers. Their incentive is pretty simple. The more people trade, the more fees they make. And watching over everybody are the regulators, like SEBI. Their primary job is to make sure the game is fair, mainly by cracking down on illegal information advantages, like insider trading.
So we've met the players, but what makes them act? What tells them where to put their money? Well, if capital is the blood of the market, then information is its nervous system. It's the electrical signal that directs all the action. And you have to understand, this signal doesn't reach everyone at the same time.
You see, not all information is created equal. There are really two main types you need to get. First, there's fundamental information. This is the why. This is stuff like corporate earnings, GDP numbers, or RBI policy decisions. This is information that changes the theoretical, long-term value of a company. Second, and just as important, is order flow information. This is the how. It's the real-time footprint of buying and selling pressure. A sudden flood of huge market orders tells you someone, somewhere, wants in or out right now.
And this right here leads to one of the most important concepts in all of finance, information asymmetry. It's the simple idea that different people get information at different times. An institution might get a hint about upcoming earnings a few hours or even days before the public announcement. That time gap, that asymmetry, creates a temporary advantage. It's a huge source of both opportunity and risk in the markets.
All right, so we've got the players and we've got information zipping around, but how does a piece of news actually, make the price move? It's not magic. It's a very clear mechanical process. Let's break down exactly how information gets translated into the price you see on your screen.
Let's make this real. Imagine Tata Motors announces surprisingly strong monthly sales data. That's step 1, the information event. Step 2 is the valuation update. Instantly, analysts and fund managers update their spreadsheets and decide the stock is now worth more. So step 3, they show order aggression. They don't just place a passive bid and wait. They send aggressive market orders to buy immediately at any price. Step 4 is liquidity consumption. These market orders slam into the order book and completely eat up all the passive sell orders that were just sitting there. And finally, step 5, price discovery. Once all the shares available at say 805 rupees are gone, the price has to jump up to 806 to find the next willing seller. And that is how price moves.
So if there is one thing, just one thing you take away from this entire session, let it be this. Price does not move because of opinions. It doesn't move because of fair value calculations alone. Price moves only when one side, either the buyers or the sellers, becomes more aggressive than the other. It's the act of aggression, of consuming liquidity, that forces price to a new level.
Okay, so let's take all this theory and apply it to a market we all know well, the Indian market. It has a really unique structural dynamic, which is largely driven by the push and pull between two types of giants.
On one side, you have the foreign institutional investors, or FIIs. Their capital comes from abroad, and their decisions are often driven by global trends. When they're feeling bullish, they can set major upward trends in our market. When they get scared, they can pull money out just as fast. But on the other side, we now have the domestic institutional investors, or DIIs, and they are fueled by the incredibly powerful and steady flow of SIP money from millions of Indian retail investors. They often act as a stabilizing force, buying and absorbing the selling pressure from FIIs during a panic. This dynamic is a huge reason for our market's resilience in recent years.
Okay, this has all been a bit high level, right? Institutions, regulators, information flow. But what is all of this entire architecture? What does it actually mean for you as an individual investor? This is where it gets really practical.
Listen, this is probably the most important part for you. You will never have an information advantage over a large institution. It's impossible, so don't even try to play that game. Your true edge lies where they are weakest. It's your agility, the ability to get in and out instantly, and your patience. You are not forced to invest. You can sit in cash and wait for the absolute perfect pitch, something a fund manager under pressure simply can't do.
And when you don't understand this structure, you end up making the classic beginner mistakes. Like chasing news, by the time you read it in the headlines, the institutions have already moved the price. Or ignoring liquidity, buying a small stock and then realizing there's nobody to sell it to when you want to get out. And maybe the biggest one, misunderstanding motivations. Not realizing that a fund might be selling a great company simply because they need the cash, not because something is wrong with the business.
All right, let's wrap this up and quickly summarize the core architecture that we have just mapped out.
So what's the big picture? Remember, the market is not a random number generator. It's an ecosystem of competing players. And price movement isn't random either. It's the direct result of aggressive orders overwhelming passive ones, all triggered by the flow of information. You now have that foundational blueprint.
And this is just the beginning. In our next session, we're going to build right on top of this foundation. We'll get into the actual tools of the trade, the different types of market orders, and look at the execution strategies all these different players use to navigate the market.
So I'll leave you with one final question to think about until next time. We've just laid out the entire game board and identified all the major players. Now that you know who they are, what drives them, and what their weaknesses are, how are you going to change your game? Thank you for your time.